Tonight, ladies and gentlemen, we confront a rather stark reality, a reality that affects every single one of us, and that is the precipitous fall of the Indian rupee against the US dollar. It's a huge drop. Today, the rupee stands at a record low, 86.6 against the US dollar. That's a staggering 37% depreciation since January of 2015. Mind you, this isn't just a number. It's a reflection of the growing burden on the common man. For parents who've been dreaming of sending their children abroad for higher education, this kind of decline isn't just disheartening, it is actually devastating. Costs have ballooned and it's made those aspirations feel increasingly out of reach. For families who are planning a foreign vacation, the dream that was once attainable seems to be slipping away. With the cost of everything from airfare to accommodation, all of these are skyrocketing. And look at Apple's iPhones. They've consistently been more expensive in India compared to what you pay for them, perhaps in the United States. And this even as Apple has ramped up local manufacturing under the Make in India initiative. But despite these efforts, factors like import duties, taxes, currency depreciation, they continue to drive up prices for Indian consumers in every which way. Many Indians would travel abroad, particularly to the US, and purchase their iPhones there at lower prices, combining that trip with a vacation. But now with the rising cost of international travel, not least because of a weaker rupee and higher airfares, that option is becoming increasingly less viable. And no, it doesn't really stop there. The depreciation is hitting home. It's hitting home in our everyday lives. The jewelry you plan to buy for a loved one's wedding, the fuel that powers your daily commute, even the electronics that you rely on, that we just spoke about, they're all becoming more expensive. Imported goods and those that go into making some of them, all of these are rising in cost. And as these prices climb, they're pinching the pockets of consumers across the country. And what's more, it's not just about the rupee losing ground against the US dollar. It's about the value of the rupee itself shrinking over the past decade. It's eroded by inflation and exacerbated by high taxes. So are we as consumers, as the common man, are we left to bear the brunt of a system that seems to be slipping out of control? Is the Reserve Bank of India really powerless to stem this tide, as it were? And has the government done enough to manage inflation, to control taxes, to shield the common man from this financial storm, as it were? So tonight, to break this down, we are joined by a distinguished panel exploring pressing questions. Lloyd Matthias is an independent director with sharp insights into the economic landscape. We've got Devendra Pant joining us. He's chief economist at India Ratings. He's going to help us decode the broader economic implications. And Jayesh Mehta of DSP Finance also with us, just to broadly understand the impact on our investment. So, gentlemen, let's just straight dive into the heart of this issue and see if there is a way out of this financial labyrinth through government tax policies, through moves by the RBI. Let's just understand what's at play over here. And for that, I want to come to you first, Lloyd Matthias. The rupee having depreciated by 37% since 2015, a percent since the beginning of this year. How do you see it hitting the common man?
Thanks, Vikram. I think the rupee's depreciation is really the symptom, not the disease. Right? Clearly, there's a big concern, and 86.60 is clearly a new low. I think we have to look at the larger factors at play that have impacted the rupee versus the dollar. I think one is India's continued dependence on imported oil. I think that's important. Secondly, I think the volatility of global capital flows, I think that's kind of exacerbated the last few months, specifically with the change in guard in the US that's coming up. And then, of course, the whole geopolitical tensions, the fact that on two different fronts, there are various issues. I think that's one big factor. The other, I guess, which I guess affects markets globally, is the dollar's meteoric rise, thanks to a confluence of factors. Firstly, of course, is the US economy's surprising resilience, right? It has continued to outperform. Even last year, the US economy did remarkably well. And one of the world's, 27% of the world's GDP. So I think that was one big plus. The second is reduced expectations of Federal Reserve rate cuts. I think that threat is now receding, and therefore the dollar kind of gains in strength. And of course, what people expect with Trump 2.0, corporate rate cuts, global trade face-offs, tariff escalations. I think all these are really adding to the attractiveness of the high US Treasury yields. So I think that's the large picture. I think the issue that needs to be brought to book is that does India's rupee downslide versus the dollar impact lifestyles of Indians significantly? I think the one obvious thing that we all see is that clearly, obviously, things like international travel or Indians sending their kids abroad, that is certainly going to be more expensive. But in the larger context, should the RBI being, pull out all stops to slide the downslide? I think the jury is out on that. I'm not too sure that we, continuously need to keep, just like a egoistical thing, keep the rupee down. You have to understand that markets globally, I mean, other currencies worldwide have all slid against the dollar. And
Right.
the rupee relatively has performed better. There's no denying the fact that there's a downslide. So I think right now, the kind of panic that seems to be spreading, specifically in the business press, is a little unwarranted. I presume some of it, albeit, is fueled by a few political, brinkmanship. But I think primarily, I'm not too sure that the fact that the rupee is the new low of 86.660 is going to hit the average Indian too much.
Really, I mean, one part of it, the lifestyle impact that you said, Mr. Matthias, the cost of foreign education skyrocketing because of the rupee's depreciation, it is going to affect aspirations of Indian families, wouldn't it? And that's just one example. So when you talk about the impact, how exactly do you think, or do you think that's going to be negligible?
I think if you look at the sheer number, I mean, you and I know what we're talking about. We're talking of a microcosm of the Indian population.
Even
A
so.
fraction of 1% who really, can afford or do send their kids abroad. And of course, these are those who don't really qualify. In any case, I believe, Vikram, the RBI has been walking a tightrope balancing inflation, forex stability, and the need to protect India's growth engine. The fact that we are trying our best to keep the fiscal rate down so as to keep inflation under check, I think the RBI has been doing, by all indications, a pretty good job. Now, selling dollars to limit the rupee slide, tweaking the CRR and raising ceilings on FCNR deposits are tactical moves rather than a broader strategy. And I'm not too sure, this pressure building up should really make the RBI move in a knee-jerk reaction. You're talking of a small section, but on the positive side, you recognize that with the rupee sliding, our export ability goes up significantly, right? And Indian exports haven't fared too well. So in that sense, it's a small up. And just given our balanced situation, I think that would be a clear positive tick.
Take this across to Devendra Pant to better understand the impact on the economy. Mr. Pant, how do you compare the fall of the Indian rupee against the US dollar and the fall in value of the Indian rupee within our economy as we grow? Because what 100 rupees could buy in 2015 and what it can get you today in 2025, now there is a fall over there as well. So help us understand that.
Well, there'll be two rounds of impact. There'll be first round impact and there'll be second round impact. So the first round impact we are going to see is all the cost of all the imported items going to go up. Now here the oil is very tricky. Now we had seen the oil price, palm price as remaining flat of so many months, whereas the global prices have moved up and down. Now, which are the other commodities where have dependence? I think your report also pointed out the pulses is another commodity. Then the other oil, we talk about crude oil. Then there's the edible oil, where our dependence on the import is way too high. Again, closer to 40-odd%. These numbers are straight away going to hit us on the inflation front. Already, despite the inflation coming down 10 basis points lower than the RBI forecast for the third quarter, some of these uncertainty have reduced the probability of a February rate cut. It's only if the incremental data from here gives a conclusive evidence that the inflation will move down in the same trajectory. Otherwise, we may see another pause in the monetary policy. The second, this is the first round impact, which hits us everyone by the inflation. It hits more to the poorer people compared to the people like four of us who are in this program. The second round impact is going to come when your import bills start rising, your GDP absolute level and GDP growth starts dwindling down. That goes down depending upon how much is the hit on the trade side, both goods and services. Now, there is one thing which we always talk about: the weaker rupee means exports are going to perform. The same way we have this philosophy that lower interest rate will lead to higher investment. In both the cases, it is the demand which prevails over the prices.
Correct.
Now, if the global demand is strong, despite a weaker rupee, despite a stronger rupee.
Yes.
But again, when we are talking about the rupee, we have to see how our competitors are doing. So
Correct.
if you look at the other emerging market pack, I'll just take 30 more seconds.
Yes.
If you look at the emerging market pack and compare the Indian rupee till middle of December, Indian rupee was one of the best performing.
Yes.
I think Jayesh Bhai can add more to it.
Exactly.
But when we had seen now
Yes.
any event taking place, the stability suddenly starts eroding, and we are seeing the larger depreciation.
Exactly. Yes. Well, let me take that across to Jayesh Mehta. Mr. Mehta, this weakening rupee, it has significant implications, especially for India's debt market. In terms of investor sentiment, especially in the bond market, how do you see this really playing out?
So if I look at it really, I just want to make one myth very clear, right? Typically, we associate currency depreciation, appreciation with the interest rate differentials and stuff. Now, if you really look at it, we really don't have foreign debt investment to a dramatic extent. We do have some, but it's not so huge, right? It's always been the equity investment from foreigners, which have been always there. And I think, the equity guys actually look at growth more than interest rate differential. And I think that's where I would say from a local side, we are a little bit struggling on the growth. And therefore, the focus rather than doing, the traditional stuff is like, okay, higher interest rate, therefore your currency gets protected and stuff like that. More than that, I would say it's about the growth. So that's a separate topic, but I just wanted to make, we actually did the similar mistake in 2013. So it is more for growth. So we need to focus more on growth if we need to attract foreign investment or dollar inflows.
Are we doing
rather than just pure interest rate differential game and therefore like trying to match?
Yes, but are we? Is the focus on growth as pronounced as it needs to be in these times? How do you assess the government's fiscal policies in trying to mitigate the impact of the rupee's depreciation on the common man?
So I think, when you try to focus on the macro and therefore that will come with the time. All of us, we know that we have lower than expected growth in last 3 quarters. This quarter, again, there is some expectation, but I think overall the industry is feeling there has to be some fiscal as well as monetary stimulus to come. But that's the expectation. I'm not saying that has to happen or that will happen, but that's the expectation. And the right way to go about it, tackle this kind of situation is, focusing on the growth. Having said that, right now it is, people have termed it U.S. exceptionalism. Everything is all about U.S. Everything else in the world, nothing is doing well, right? It's only U.S. And we don't know whether it's a momentum situation, whether it's the way it's going to stay for longer that way. But as of right now, with the new government there in U.S., people are expecting tariff hike.
But there's a lot of uncertainty because of that as well. Yes.
Yeah,
yes,
all sort of things.
Yes.
Stronger dollars, tariff hike. So there are also a lot of contradictory expectations.
And it's in these times that we are seeing the rupee drop. While there is so much volatility in the markets, the expectations, what Trump administration is going to bring in.
But rupee drop, I would say, is more, while the macro does matter, while the oil and all the prices matter. But, that gets spread over a year, right?
Right.
For FPI, equity inflow or outflow has immediate impact, right?
Yes.
So like today's number, you almost like $1 billion is the net sell of FPI. That's an immediate impact as of tomorrow, right? So that much dollar has to go out, almost a little less than $1 billion, maybe 800, 900 million dollars.
Yes.
Yeah, that will have to go out. And when the sentiments are weak, right? So normally, if you look at it last 4 months, right, we have been seeing continuously outflow.
Right.
Almost $300 million,
We were talking about this yesterday, indeed.
Yeah.
And that itself has its own bearing on market sentiment right now. But I want to take that question on inflation to Mr. Matthias for a moment. With the rupee now at its lowest against the dollar, since Mr. Pant was raising the point about the immediate implications for inflation in India, Mr. Matthias, how do you see that impacting corporate earnings, which have been subdued, and that has happened over the last couple of quarters?
Vikram, I don't think that bodes very well for our economy. I
Right.
think one of the good things over the last couple of years is that inflation has been relatively moderated pretty well. I think if we see a sudden spurt, given the fact that people expect a lot of turbulence market wide over the next few months, given the change of guard in the US, given the fact that even the global tensions continue, one is hoping for things to be better. I think inflation at a general level will be a genuine issue that will also force the RBI's hand, which till now has been slightly more nuanced, has been slightly more guarded, shall we say, to possibly, do all it can to prevent the slide. And I think that, to my mind, is dangerous. When populism dictates economic measures, there's always a concern. At one level, of course, there's population at a more grassroots level when elections come and freebies and such like. But at a macro level, when populism dictates a bit of this, I think that is a genuine concern. Because one of the calling cards, one of the good things this government has sort of maintained over the last few years has clearly been keeping India's fiscal situation tight, right? And I think the moment that loosens up a bit, that could be have far more significant implications for our economy in general.
But Mr. Matthias, about 10 years ago, this was very strongly a political issue, wasn't it? So now we are looking at the slide of the Indian currency in a rather positive light. We need to kind of put that in context because there is the psychological impact on consumers to consider as well.
Oh, absolutely. I think one part is the reality of it, as both the other panelists have said. I think the other part is a little bit of the political brinkmanship. The fact that time and again, one begins to look at this larger context. And like I said, at a very mass level, it matters to a handful of people who directly transact in dollars. The larger impact in terms of oil import costs, the larger impact of inflation all around is certainly significant. But the moment it gets into this, kind of political brinkmanship of I manage the downslide better or I manage to keep the rupee strong, I think then we're looking at politics walking into economics, which always makes for a tinderbox, which is not healthy in the long run.
Ask Mr. Pant, what are the options before the RBI other than interventions in the forex market, which of course has a bearing on the health of our forex reserves? But how much power lies in the RBI to control where the rupee stands against the US dollar?
Well, RBI has the stated objective and they stated policies, they come in at the time of controlling the volatility. And as we had seen even in the last episode, during the taper tantrum, all the efforts were made by the RBI to control the slide of the rupee, that proved unfruitful, or they didn't achieve much objective. As Mr. Ajay said, it is what the growth is, which they look at it, and how the capital flows takes place. So yes, it's growth, inflation, it's deficit. All these things plays in mind because if the growth potential of the economy is high and we are a capital-starved economy.
Yes. So do you see the RBI doing something more than the interventions that we know about?
Well, it's a very statement which many people will not like. Ultimately, the root cause of problem from where it generates is the inflation.
Right.
The moment you have the inflation under control, I'll not say that everything will be very good, but you will achieve solution to most of the problem in the economy.
Right.
Suddenly
including the slide of the Indian rupee against the dollar?
Yeah, you have this low inflation regime, your demand will start rising, your investment will go up. I hope it is that way. It's not that easy, but yes, that's the traditional way.
Mr. Mehta, do you agree? Let me take that to Mr. Mehta. Do you agree, considering the rise in import costs, how do you think that's going to impact Indian businesses? Because even the consumer-facing ones, FMCG in particular, they will have to hedge against currency risk, protect their margins. There's a lot that corporates will have to do as well. Do you think the burden is going to be passed on to the common man eventually? Or do you think there is more to do as far as corporates go in terms of hedging their risks?
you see, right now, trying to fight anything, because there is a wave for US dollar strengthening, right? Till that settles, right? Whatever effort you do, you will be, your efforts will be wasted. So yeah, therefore, it is always better to do a more structural, long-term, lasting. This wave cannot continue forever, right? So it's not only India, it's all other emerging markets, even developed markets, everything. Everything, there is only one market in the world as of right now. That's what people feel, right? Now, that cannot continue for long. And at some point of time, that has to change. And that is the time for you to, get back it faster. The game is basically focused on growth. Everything is linked to growth. And like, I do agree if there is lower inflation,
Yes.
the growth does matter.
But for that, the RBI has
having
also
said
got
that,
to,
you're in-
the RBI
having
has to
said that-
move on interest rates as well. That's something else that they'll need to do now
So
with the.
I genuinely believe 2013 we did a mistake by raising rates. That's where we have a second wave of sell-off coming in. I think we in India, unlike traditional economics, it is all about growth. Your foreign flows is always following and chasing growth in India rather than interest rate differential. So let's not do that mistake of trying to do something on the interest rate to stabilize the currency. Rather do something more other way around to stimulate growth. Maybe it's not only fiscal, I think also monetary policy can also help on the growth side.
Mr. Matthias, is
That's
it
what
going
I
to
would
be,
say.
do you agree with what you're hearing? As far as the RBI's moves are concerned, they've kept interest rates steady. Do you believe this is the right approach, or should there be more aggressive monetary policy measures to stabilize the Indian currency?
Commit to a definitive answer on this. All I would say is that the RBI's intervention in some level has softened the rupee's fall, right? Foreign currency reserves have been depleted by 47 billion since October 2024, which in some way has led to a liquidity crunch in domestic markets. So that in itself is a little bit of a worry. As of November, the rupee was 8% overvalued, hurting export competitiveness and worsening our trade deficit. So there is already some of the interventions that, shall we say, in broader terms, haven't gone down very well. I think the bigger danger lies in clinging to an artificially strong rupee that stifles exports, right? So, like I said, just in terms of, almost like an egoistical way to keep the rupee artificially high, will stifle exports, will discourage foreign investment, and will exacerbate the trade balance. I think that is the worry. Having said which, that does not mean the RBI should step back entirely. And its deft hand is crucial in ensuring the depreciation is gradual and avoiding panic in the markets.
Right.
But the days of defending arbitrary levels, I think that's pretty much over.
So
I
you're
think one has
saying
to
don't-
let it play. At the same time, obviously trying to keep a very, very deft look in terms of trade, in keeping our trade balance as good as possible.
So you're saying don't stifle exports, but a weaker rupee is also going to raise import costs. Do you see that affecting India's competitiveness in the global market, especially in technology and manufacturing, two pieces that we want to push in a big way?
Was that for me, Vikram?
Yes, Mr. Matthias.
Yeah, so I would say yes. I think the very fact that our rupee slide against the dollar at some level affects our competitiveness. But like I said, it's always not purely a bilateral relationship. One has to look at how the dollar is faring against other global currencies. And like one of the other panelists clearly pointed out, the fact that for a long time we were doing better than most Asian currencies. Post December there has been a bit of a drag. But again, if you look at the Philippine peso or the Thai baht, I think we haven't really slid so alarmingly. Like I said, political tensions make the focus be very strong in terms of the rate of depreciation in the last 2 years versus previously. I think that's always a matter of debate. But like I said, when politics start beginning to influence decisions on the economy and the RBI feels pressured, I think that's when a bit of a warning bell needs to be sounded.
That across to Mr. Mehta, you think a weaker rupee is going to raise the import cost because you are continually saying that it's about growth, and both exports and imports are going to have a key impact on how quickly we grow, especially if you want to build our competitiveness in the global market.
So I think weaker rupee will help individual companies on the export side, but I don't think as an economy, because right now when I'm saying it's a wave, it's not only us who is depreciating, right? So, other emerging market, other exporting markets are also depreciating. So it's not going to give us some added advantage for the export to the same guy who's buying from us and maybe from, say, other Asian countries where that is also depreciated enough. So he's not going to get any major advantage. So, that's always been, whenever there is a, depreciation across the board.
Right.
Yeah, only if we were depreciating and others were not depreciating, then we as a country get an advantage for export.
Sure.
But having said that, as I said, people do talk about the real rate of rupee and stuff like that. As I said, if you have growth, real rate of rupee will also change, right? Therefore, your expectation of where the rupee should be.
Yes.
At this time, when there is a wave, we cannot fight. Say, as I was trying to say earlier, like there was $300-500 million sale, but there was no wave. So you could manage the currency depreciation in spite of the sale being there.
Sure.
But now when there is a wave, when you have $300-500 million a day sell, there are other traders, right, worldwide.
Yes.
They will also trade along with that. So, the impact is $5 billion when there is a $500 million sale. The others are also going to sell. How can you fight that kind of wave?
Sure.
And I think it's the right thing what they have done to let it go where it is. My only thing is focus on growth and both sides. And I'm saying non-traditional way. Also, monetary policy should support growth.
Yes.
I'm not saying cut rate.
Right.
Get liquidity.
Yes,
Get
you
liquidity
did say that.
system.
Yes. No, indeed, it is evident that the depreciation of the rupee, it touches every facet of our lives. The dreams of a better future through the kind of investments that we make, the daily necessities that we buy and can't do without. The road ahead requires not just reactive measures, but proactive strategies, both from the government and the RBI, to try and stabilize the rupee, control inflation, and ensure that the common man is not left to shoulder this burden alone. Thank you to our panelists, Lloyd Matthias, Jayesh Mehta, and Devendra Pant. Thank you for joining us with your insights on India Tonight.